Hello everyone, welcome to today's US Open Live webinar. This is your host Nikos Zabouras, Senior Market Specialist at FXCM. This is a webinar that takes place twice a week, every Tuesday and Thursday at 14:20 GMT, 10 minutes before the open of the US market, and during which we take a look at some of the day's or recent market events and news, and also the technical outlook of certain products, ranging from Forex to indices, even stock, commodities, and whatever draws our attention. We're currently 10 minutes out, so before we begin, please take a look carefully at the disclaimers and warnings, and then we can get started. Once again, please read through the disclaimers carefully. Okay, having done that, let's get the ball rolling. So this has been a very busy week and a busy couple of days since our previous US Open on Tuesday. So there were many news from CB talk, from central bank talk, to economic data, to geopolitical tension, to COVID jitters, many things to which markets have been reacting. Now, obviously, the overarching thing we could say is the Fed and whether it's going to shift into a slower pace of rate hikes or it will stay on its current aggressive path. Now, last week we had soft CPI inflation figures, which definitely allow for such a transition, let's say, and the markets have definitely reacted by pricing in a lower terminal rate. Now, since then, we have seen quite a few speeches from Fed policymakers, which do show a division, we would say. It's not like it's a unified message. And this makes sense because since up until their next decision in mid-March, officials will have a chance to assess two more inflation reports and one jobs report. Yes, earlier today we had weekly jobless claims which dropped, in another sign that the labor market remains strong. And we also had a rise in retail sales yesterday, which also allows the Fed to maintain its, or calls for the Fed to maintain its aggressive stance. Now, in regards to the hawks, to the central bank commentary we talked about, the latest was from super hawk Mr. James Bullard earlier today, who spoke of a limited effect on inflation from this aggressive tightening so far and called for more hikes in order to go to a sufficiently restrictive level. Of course, others were softer, let's say, and definitely looks like most of them are definitely considering a slowdown in the pace of hikes, meaning potentially a 50 basis points increase after a series of 75 BPS moves. Now, obviously, it's too early, as we said, for such determination. There we still have 1 month to go and many data points. And the truth is that markets have been always trying to see peak inflation, peak Fed hawkishness, and this has definitely proven ill-advised in the recent past. Now, other than that, we had quite a few news from the UK this week and today as well. We'll go over in a little bit when we talk about the GBP USD outlook, which you're already seeing on your screens. We also had retailers, US retailers, large retail stores such as Walmart this week in the spotlight, mostly encouraging results. However, Target yesterday disappointed as it now expects a decline in sales and profit margins of around just 3% for the last stretch of the year, which is the important holiday season. And actually, stock plans around 13% on Wednesday after these results. Whereas just earlier, Chinese tech and e-commerce giant Alibaba posted a surprise net loss and was losing ground in pre-market. Now, overall markets are a bit subdued this week as they digest this slew of news and data points. Last week, we had a big rebound in Wall Street, a very good week for Wall Street, and a bad one for the US dollar. But we see this contained this week. And in fact, we have the greenback rising today, Wall Street dropping with quite some intense pressure over the last few hours. So let's go ahead and get started with GBP USD. As we look at the chart, let's go over some of the recent news from the old Albion. Now, yesterday we had UK inflation jumping to 11%, which is for October year over year, which is the highest level in 41 years, and a big jump over the previous figure, which was 10.1%. And this definitely keeps pressure on to the central bank for more hikes. Today we had the long-awaited and delayed economic plan from the government. Chancellor Hunt announced £55 billion in tax increases and spending cuts in order to restore credibility and stability after the mini budget debacle in September. Now, among other things, under this plan, more people will pay the top 45% income tax rate. And the government also plans to increase the windfall tax on energy companies from 25% to 35%. Other than that, according to the OBR, the UK economy is already in a recession, and GDP is expected to contract by 1.44% in 2023. And another interesting thing is that Mr. Hunt said that the government will not change the central bank's remit, something that had been discussed from the previous Prime Minister, Ms. Truss. Now, let's go ahead and take a look at the technical outlook of GBP USD. Its recent rally falters ahead of the key 1.2050 to 1.2120 region. And let us highlight this. So you can see here, it has been running a rebound from the record lows, but this stops ahead of this key region here. And this creates risk for a pullback below mid 116s, but from the EMA 200, the exponential moving average, and below, there are multiple supports. We also have the ascending trend line from the record lows and also the daily Ichimoku cloud. So it may be hard for this region here to break. As long as we remain above the EMA 200, biases on the upside, and bulls have the ability to retest the aforementioned region here above 1.2, but it may be early to talk for further advance towards and beyond 1.2407. Again, we see a pullback, which makes sense not only in GBP/USD but in everything against the dollar, essentially, since the previous surge was stretched even if excessive, and we are in flux, let's say, as markets try to assess what the Fed will do next and other central banks, of course. Now, let's move on into Euro USD, which started the week strong with fresh highs, but rejected the 1.15 region and actually slides today. Let's bring the chart here. You can see GBP USD. You can see Euro USD now, I'm sorry. So you can see that it's losing ground today. Again, that the advance was stretched. And from here, we could see a test, even a breach of the 1.199 support. But we would need a strong catalyst to challenge the exponential moving average here. And once again, we have multiple support levels after that. Despite today's decline, which is considerable, the pair comes from a 4-week profitable streak and has the ability to push for higher highs above 1.05, but it will increase impetus for moves past 1.0609. Now, the common currency's recent visits above parity, which is here, had been short-lived. However, this time it looks better positioned to defend this level, even if we see a deeper pullback. And now let's go over to Wall Street and the broader SP 500 index. Now, similar picture here. We had an advance on the back of more dovish expectation around the Fed's hike path. And earlier in the week, it set 2-month highs above the 4K handle, but could not hold it and faced some intense pressure over the last few hours. As we had written yesterday, we can see pressure to the EMA 200 at around 4,840. Closes below this level, daily closes below this level, would put immediate bias back on the downside and would make the index vulnerable to fresh monthly lows at around 3,696. However, bulls are still in the driver's seat of the stage, and they can return above the 4K mark and push towards the descending trend line from January's record highs, which would be at around 4,150. So we will again need to see how markets react to the commentary. But again, we are here in a situation where it may be too early to determine the next leg of the moves. Now, leaving the technical outlook aside, let us remind you, of course, that you can always find more content from us, from the FXCM market specialists on the respective FXCM sites of your region under the market analysis tab. Let's go ahead and see what we expect over Friday and at the start of the next week. So overnight, we expect CPI inflation figures from Japan. This has been running, inflation in Japan has been running above the central bank's 2% target since April, and it actually hit 3% in September, the previous print, which was the highest since 2014. However, the Bank of Japan is in an uber dovish, we would say, policy setting with negative rates, with yield curve control, and so on and so forth, and has shown no inclination to change that. We also have UK retail sales on Fridays, And on the corporate front, we have JD's, the Chinese tech and e-commerce giant JD earnings reports its earnings on Friday. And of course, we will be looking at any commentary around central banks, not only the Fed, but the ECB as well, and the Bank of England. Now, for next week, it starts a little bit slow, but things heat up later on. Of course, we will have the chance to cover that in our next US Open, which will take place on Tuesday. And then, once again, you can find more commentary from us on your respective FXCM sites under the market analysis tab. That's it from us today. Thank you for joining. Have a good one.